Listen up because this is important. The year is 2024, and investors are hungry for yield. Interest rates have been low for what feels like forever. The market is trying to find its footing after the pandemic. That's where high-yield dividend stocks come in. These stocks offer the promise of juicy payouts. They can provide a steady stream of income. But hold your horses. Before you jump in headfirst, there are some things you need to know. Simply put, they offer something that most other investments don't, a consistent income stream. Yes, high-yield dividend stocks can be risky, but so can any investment. The key is to understand the risks and make informed decisions. So buckle up and get ready to learn everything you need to know about high-yield dividend stocks in 2024. Let's cut to the chase. There's a dangerous misconception floating around. Some folks think high-yield dividend stocks are risk-free. That's like thinking you can swim with sharks and come out unscathed. It's just plain wrong. High-yield dividend stocks are still stocks. Their prices can fluctuate, dividends can be cut, companies can even go belly up. Don't get lulled into a false sense of security just because a stock pays a high dividend. This couldn't be further from the truth. In fact, it's often the opposite. Think about it this way. Why would a company pay out a huge chunk of its profits to shareholders? Sometimes it's a desperate attempt to attract investors, even though the underlying business is struggling. Look beyond the dividend and examine the company's fundamentals. Understand the risks involved. Investing in high-yield dividend stocks without proper research is like playing Russian roulette with your money. We need to talk about something crucial: company fundamentals. This is the real meat and potatoes of investing in high-yield dividend stocks. It's not enough to chase after the highest yield. You need to understand what's driving that yield. Is it sustainable? Is it backed by solid business fundamentals? These are the questions you need to be asking. Are earnings growing consistently? Are they covering the dividend payments? A company can't pay dividends forever if it's not making money. It's as simple as that. Check the dividend payout ratio. A ratio above 100% is a red flag. Next, examine the company's debt levels. High debt can burden finances and affect dividend payments. Look for companies with manageable debt levels and a history of responsible borrowing. You don't want to invest in a company that's drowning in debt. Don't forget about the company's industry and competitive landscape. Is the industry growing? Does the company have a competitive advantage? These factors impact long-term profitability and dividend payments. Invest in companies with a solid track record and a bright future. Avoid companies in declining industries or facing intense competition. Investing in high-yield dividend stocks is like buying a house. Inspect the foundation, the roof, the whole 9 yards. Look beyond the flashy dividend yield and dig into the company's fundamentals. That's how you separate the winners from the losers. For example, Company A has a payout ratio of 40%, indicating a healthy balance between dividends and earnings. Meanwhile, Company B has a payout ratio of 120%, a clear red flag. Not all sectors are created equal when it comes to dividends. Each sector has its own risks and rewards for dividend investors. What works in one sector might not fly in another. Understand sector-specific risks before investing. The energy sector offers high dividends but is cyclical. When oil prices drop, energy companies suffer. REITs in real estate are popular but sensitive to interest rates. Utilities provide essential services but face heavy regulation. Diversification is key. Spread investments across sectors to mitigate risk. Section 5. The interest rate rollercoaster. Its impact on dividend stocks. Hold on tight because interest rates can be a wild ride for dividend investors. They can make or break your portfolio. See, interest rates and dividend stocks have this love-hate relationship. When interest rates rise, dividend stocks tend to fall out of favor. When interest rates fall, dividend stocks become the belle of the ball. It's a constant push and pull. Here's the deal. When interest rates rise, bonds and other fixed income investments become more attractive. They offer higher yields, which can lure investors away from dividend stocks. Plus, higher interest rates increase borrowing costs for companies, which can impact their profitability and their ability to pay dividends. It's a double whammy. On the flip side, when interest rates fall, dividend stocks become more appealing. Their yields look relatively more attractive compared to bonds and other fixed income investments. Lower interest rates also reduce borrowing costs for companies, which can boost their profitability and potentially lead to higher dividend payouts. It's a win-win. The key takeaway is this. Interest rates are a major driver of dividend stock performance. It's crucial to keep an eye on interest rate trends and their potential impact on your dividend portfolio. If interest rates are rising, consider adjusting your portfolio accordingly. You might want to reduce your exposure to rate-sensitive sectors like REITs and utilities. On the other hand, if interest rates are falling, it might be a good time to increase your allocation to high-quality dividend stocks. Remember, investing is a marathon, not a sprint. Don't panic and make rash decisions based on short-term interest rate movements. Instead, focus on building a diversified portfolio of high-quality dividend stocks that can weather the inevitable ups and downs of the market. Unearthing the best high-yield dividend stocks. This is where the rubber meets the road. Understand the risks and opportunities. You need a solid strategy to find the winners. That's what we're going to talk about. Look for companies with a history of dividend growth. This shows commitment to returning value to shareholders. It suggests the business is healthy and growing. Companies that consistently increase their dividends are like money printing machines. They're the ones you want to own. Examine the company's financial strength. Look for strong balance sheets, manageable debt, and healthy cash flows. These companies can weather economic storms and maintain dividends. Avoid companies with shaky financials. They're ticking time bombs. Just because a stock pays a high dividend doesn't mean it's a good value. Look for reasonable valuations relative to earnings, cash flow, and assets. There are plenty of bargains out there if you know where to look. Do your homework. Read financial statements, understand the business model, and analyze the competitive landscape. The more you know, the better equipped you'll be to make informed decisions. Finding the best high-yield dividend stocks is like panning for gold. It takes time, effort, and a little bit of luck. With the right approach and patience, you can strike it rich. Section 7. Dividend growth, the unsung hero of long-term returns. Now let's talk about a secret weapon in the world of dividend investing, dividend growth. See, it's not just about the yield, it's about the growth of that yield over time. That's where the real magic happens. Dividend growth is like compound interest on steroids. It can supercharge your returns over the long haul. Think about it this way. If a company consistently increases its dividend by, say, 5% per year, your annual income from that investment will also grow by 5%. Year after year, your dividend payments will get bigger and bigger. That's the beauty of compounding. Over time, even small increases in the dividend can make a huge difference in your total returns. But here's the thing. Not all dividend growth is created equal. You want to look for companies with sustainable dividend growth. That means the company has a history of increasing its dividend and is likely to continue doing so in the future. Look for companies with strong earnings growth, manageable debt levels, and a commitment to returning value to shareholders. These are the hallmarks of sustainable dividend growth. Remember, dividend growth is like a snowball rolling downhill. It starts small, but as it gathers more snow, it gets bigger and bigger. The same goes for your dividend income. The longer you hold on to companies with sustainable dividend growth, the more your income will grow. It's a powerful force that can help you achieve your financial goals. So don't just chase after the highest yield. Look for companies with a history of dividend growth, focus on sustainability and long-term potential. That's how you unlock the true power of dividend investing. Financial strength, the bedrock of sustainable dividends. Financial strength is critical for high-yield dividend stocks. Think of it as the foundation of your dividend house. If the foundation is weak, the whole thing can come crashing down. Invest in companies with rock-solid financials. Look at the balance sheet. More assets than liabilities indicate financial strength. Pay attention to the debt-to-equity ratio. A lower ratio is generally better. Examine the cash flow statement. Strong and consistent cash flow is essential. It allows the company to pay dividends. Finally, consider profitability. Metrics like net income and return on equity are key. Profitability drives dividend payments. Financial strength is essential for sustainable dividends. Section 9. Valuation, separating value from hype in dividend investing. Listen up, because this is crucial. We need to talk about valuation. Just because a stock pays a high dividend doesn't mean it's a good investment. You need to make sure you're not overpaying for that dividend. That's where valuation comes in. It helps you separate the true bargains from the overpriced traps. Think of valuation like going shopping for a new TV. You wouldn't just buy the first TV you see, would you? You'd compare prices, features, and brands to make sure you're getting the best deal. The same goes for investing. You need to compare the price of a stock to its underlying value. There are many different valuation metrics you can use, but some of the most common include price to earnings, PE ratio, price to book, PB ratio, and dividend yield. The PE ratio tells you how much investors are willing to pay for every dollar of earnings. The PB ratio compares the market price of a stock to its book value, which is the value of its assets minus its liabilities. The dividend yield tells you how much dividend income you can expect to receive for every dollar you invest. When it comes to valuation, there's no one-size-fits-all approach. What's considered expensive in one industry might be considered cheap in another. It's important to compare companies within the same industry and consider their growth prospects, financial health, and dividend sustainability. Remember, valuation is key to successful dividend investing. Don't get caught up in the hype and overpay for dividends. Take the time to analyze a company's valuation and make sure you're getting a good deal. Section 10. The verdict: balancing rewards and risks in the world of high yields. All right, folks, it's time to bring it all home. We've covered a lot of ground today. High-yield dividend stocks can be a valuable addition to any diversified portfolio. They can provide a steady stream of income and offer potential for capital appreciation, but they come with risks. Prices can fluctuate, dividends can be cut, and companies can go bankrupt. They require patience, discipline, and a long-term perspective. Do your homework, understand the risks, and invest wisely. Remember, investing is a marathon, not a sprint. You can achieve your financial goals and live your best life.